Therefore, holding the interest rate where it's at is absurd. It's just absurd and distortionary, hurts the economy in the way we said, the 20% of the economy. The rates should be cut. We are only in the third year of what would be typically a 6 to 8 year recovery.
How would you describe the current state of the U.S. economy? Peter, thank you for coming on today. I think I'm going to learn a lot from you. I've never had an economist on before, so you might lose me in a couple places. I'll probably have a lot of questions, but let me kind of give you background. You're founding principal of Linneman and Associates, a leading real estate advisory firm, and you also published the Real Estate Finance and Investment Risk and Opportunities. It's also known as the Blue Book, correct? Now, how often do you put that out?
Well, I think we're on about our 6th edition. It's been like 21 years.
Okay, yeah.
Used in, I don't know, 200 universities and lots of major firms.
Yeah. Well, I'd heard about it. I had not read it, but what a wealth of information. So thank you very much for putting that out. You're also voted one of the 25th most influential people in real estate by Realtor Magazine. And New York Observer said you're one of the 100 most powerful people in New York real estate. So you're a bit of a celebrity. I'm not sure what to do with you.
Well, yeah, if you believe those kind of polls, anything is true, right?
All right. Well, I'd like to dive right in, Peter. I want to really get your thoughts on this. How would you describe the current state of the U.S. economy in your words?
Pretty good.
Okay.
Not spectacular, but pretty good. What people forget is that we had a breathtaking recession. I mean, literally, we had 23% of the labor force collecting unemployment. We forget that a little over 4 years ago, there was nobody on the streets. You couldn't go to the shopping center. You couldn't go to you couldn't go to a restaurant, right? Not that you didn't, you couldn't. We forget that. We forget all that phenomena. Not just here, around the world. In China, they were welding people in their apartments, literally welding people in their apartment buildings, right? So we forget that. That put a tremendous shock, and it cleaned out a lot of the excesses in the economic system. We had a long economic string of growth, not spectacular growth, but a long growth, and the excesses got cleaned out. What do I mean by that? Imagine a retailer that was on the verge of going out of business. Well, they went out of business in 2020 and early 2021. We kind of purged the system of its weaknesses. And in fact, we purged the system of some strong. Like, I'm sure you had one of your favorite restaurants go out of business, and they wouldn't have gone out of business absent that, or a retailer who went out of business, but wouldn't have gone out of business. Or maybe you had a really good employee who quit working, and otherwise they'd have still been working, right? So a lot of impacts. We are only in the third year of what would be typically a 6 to 8 year recovery. And that's sort of how long. There are not notable excesses in the economy. And in fact, GDP in real terms, which is a crude measure of the economy, is still about 2% below trend. Now, trend's not perfect, but trend shows what is more or less possible if all we do is average, right? So when I say trend, just think of it as more or less what we can do if we only do about average. Well, we're still, even though we're higher than we were pre-pandemic, it's 4.25 years later, and we're 2% behind. So we're about 2/3 of a year behind. That will make up over the coming years because we can do it. It's pent-up demand, if you will. Things we want to do and still need to do. We have pockets of real pent-up demand. For example, medical, healthcare. Just think of all the people who put off getting cataract surgery. I was teasing before we started about I had cataract surgery just before the pandemic, fortunately. But think of the people who put it off because you couldn't get elective surgery for about a year and a half in many places.
Sure.
And so lots of automobiles, we were afraid to buy them. Just as we were willing to go out and buy them, we couldn't find them. And then just as we could find them, because supply picked up, the interest rate went up, so people forestalled. They're going to buy those automobiles sooner or later, just a matter of when. So we have pockets like that in the economy. Travel and tourism is another good one. We saw pent-up demand for travel and tourism. So the economy has a lot of pent up. The economy is being dragged down needlessly by the Fed's interest rate. And people say, well, how can the economy grow at these high interest rates? And the answer is only about 20% of the economy is even affected by interest rates. You say, how can that be? Okay, well, think of government. Are we suddenly saying since the interest rate's high, we're going to need a smaller military? That'd be absurd. Or that we shouldn't have as many police or firemen or teachers? That's absurd. Or by the way, go to healthcare. By the way, government is 35% of the economy, completely insensitive to short-term interest rates. Healthcare, if you were to have a heart attack right now, heaven forbid, you're not going to say to your assistant, no, leave me alone until Powell cuts the interest rate. I mean, or if somebody is due to deliver a child, they're not going to say, I'm going to hold the baby in until Powell cuts the interest rates. That's absurd. Well, that's 18% of the economy is healthcare. And education. Nobody's saying I'm not going to send Johnny to school because interest rates are high. Nobody, right? So when you tally all that up, you get down to around 20% of the economy is interest rate sensitive. We happen to be in a business that is very capital intensive.
Right.
And the real estate, and especially development, very interest rate sensitive, right? But there are many businesses, education, not sensitive at all. Mm-hmm. Healthcare, not sensitive at all. So that's how the economy is growing. We have normal growth, plus this pent-up demand growth being dragged down by some high interest rates on about 20% of the economy. So we're doing okay. Not spectacular, but we're doing okay. People have jobs. I mean, think about it. What do people want? They have jobs. They have income has somewhat outstripped inflation, not massively, but somewhat outstripped inflation over the last 4 years. So they have jobs, they have income, their homes are up in value. They're doing okay. Are they doing spectacular? No, but they've never done spectacular, right? We've never done spectacular. It's like an old person. You never feel great. It's just a matter of how good do you feel?
Yeah, that's for damn sure. What about credit card debt? I keep hearing how high it is. Is that true?
Well, credit card debt's it's a bit mysterious. You can track the data, but the data is a bit unclear. So go back a long time ago when I was in college, right? So like 55 years ago. And nobody had credit cards.
Right.
Nobody had credit cards, right? Well, then people started getting credit cards and they charged. And now, as you know, people use credit cards mostly for convenience, not for credit, but for convenience, right? Just wave your card and you're going to pay your bill off in the 30-day grace period, never entail any interest charges, right? So what's happened over time is that credit card debt per capita goes up, but it's largely illusory because it really reflects more the use for convenience than debt. Now, there are some people who really do use it as debt, right? But not most. And that gets increasingly true. So yes, credit card debt is up, but most of it is not debt. It's very hard, carefully guarded industry secret as to how much that is. I've had off the record conversations with some executives, and I think it's fair to say 50 to 60% of credit card debt these days is not debt. Like, so when you went to dinner last night and you charged it on your credit card, you did not really think of it as debt on your balance sheet.
No.
Because you know you're going to pay it off within 30 days, right? It's a float issue. It's a convenience issue. So it's a little hard. It's a great headline, credit card debt is up,
Yeah.
but it's not necessarily profligacy. And in fact, it's hard to sort out how much is increased convenience use and how much is profligacy. And it's some of both. Credit card defaults are up as a percent of outstanding credit card debt. However, it's still notably below where it was pre-pandemic. So the bad news is up, and the good news is it's still pretty low, right? And so that's kind of captures the scenario of debt in general, I think.
What do you think the health of the U.S. consumer? You think that most consumers is staying pretty strong?
Again, yes, compared to normal,
Right.
no in a perfect world sense, right?
Okay.
When you were 23 years old,
I don't remember that far
by
back.
standards of a 23-year-old, you were kind of normal,
Right.
but it's certainly not where you wanted to be, right? And I think we have to remember that. You know, we are pretty normal as a consumer with two big footnotes. One big footnote to the good is that huge amounts of debt were locked in by about 42% of all homeowners. Excuse me, 42% of all households locked in mortgages 4% or less for up to 30 years. And of course, those are kind of record low rates. Some of them sub 3%, right? And so they actually are in better shape than normal for whatever debt they have, whatever income they have. Second is the other footnote is wealth is up, but wealth, as you know, is, you know, you didn't have wealth when you were 23 years old. Wealth is something that's largely accumulated as you age. You save, you get higher incomes, you save, and so forth. And we do have a lot of wealth. We're at record levels of wealth for households. Yes, it's concentrated disproportionately among the older, not old, but older, but it always has been. So we just have more of it. And let's face it, I don't know about you, but one of the ways a lot of kids and grandkids are affording their lifestyle is the wealth of their parents and grandparents, right? And the incomes of their parents and grandparents. And there was a recent study that showed pretty definitively that objectively, those 20 to 35 are better off today than their predecessors when they were 20 to 35. They're not better off than their 55-year-old parents. They're just better off than their 55-year-old parents were when they were 20 to 35. They're not better off than their grandparents. They're better off by a lot than their grandparents were when they were 20 to 35.
Sure.
Are they all Bill Gates? No. It's a struggle. It's a struggle. That's why we work.
What about housing? I want to get your take on housing and where we're going with that. Multifamily, is there enough development happening right now, do you think?
Well, housing let's take single family because that's the dominant one of housing, right? Let's take that first and then come to multi. And obviously single and multi compete at some margin, right? Not a direct margin, but at some margin. Single family housing is underproduced by about 3.5% over the last 12 years total. Okay, over the last 12 years, we have delivered 3.5% less single family housing than there are population would have otherwise suggested we needed. Okay. Now, a 3.5% shortage doesn't sound like a lot, and it's not for something like bubblegum, Because if there's a 3.5% shortage of bubble gum, you'll do chewing gum or candy or not at all, right? If the price tries to go up. But housing is something people really want. So a 3.5% shortage has pushed prices up enormously and steadily over those last 12 years. And it's not going to go away. You're not going to eliminate a 3.5% shortage of housing in a year or 2 years, and maybe not in a decade. That's 3.5 million homes. 3.5 million homes. We only produce about 1.1 million at best in most years. What, we're going to produce 4.6 million single family homes suddenly? No. So why are home prices going up faster than inflation? It's very simple. We have a shortage. You know, the simplest lesson in economics, supply and demand. You have a shortage, prices go up. And they're going to continue to go up. If you don't believe it, they're up in spite of high mortgage rates, right? Yeah. And everybody said, oh, the mortgage rate's going to kill it. And I kept saying, no, it's not going to kill it because there's a fundamental shortage. And that's the dominant. Now, how does that play out? Multifamily has a minor shortage. It's down to maybe 0.6%. 0.6% means some markets there are excesses, some markets there are shortages. By and large, not too crazy one way or the other, okay? But the fact that there's shortage of single family means the demand gets reinforced for apartments, right? In addition to what you would normally have, you have people who are saying, gee, at those home prices, I have to save another 3 years to afford the down payment, right? And that means I have to rent 3 years longer than if the home prices hadn't been so high because of the shortage. So multifamily is in pretty good shape. Multifamily is in quite good shape, except it has experienced what almost every other sector of the economy did, which is go back to 4 years ago, demand and supply both shut down for a lot of things. A lot of companies went out of business. Demand came back faster than supply. It's easier to want something than to open up a new company or to open up a new production line. And so demand outstrips supply. That's how we got inflation. As that inflation occurred, prices being high created profits, and that brought about increased supply. And that increased supply has reduced inflation. Well, in multifamily, that's exactly what happened, right? Nothing got built in 2020. Very little got built in the first 2/3 of 2021. It all got forestalled. The rents skyrocketed. When the rents skyrocketed, people said, oh, gee, I really can build now, particularly given interest rate was low on the short term. Sure. You got a supply spurt. So what you've got in most markets is a supply spurt. Not so much weak demand. It's not like demand is weak. It's that supply has spurted. Now, the good news is demand is still solid. We have good demographics. We have a lot of people having to rent because of what we already talked about. Mm-hmm. So the demand side's good. Supply is shutting down, as you know. You've seen a drop in supply of about 50% of starts. And of course, what that means is we've got soft markets in rental for the next 6 to 18 months, depending what submarket you're in. And then you're going to have a shortage of apartments again because demand will continue to grow. But because we didn't start new apartments, there'll be another shortage. And you'll sort of make up in 18 to 24 months the rents you didn't get today. You know, that's kind of how markets play out.
Mm-hmm. You know, I know everybody's dying for me to ask you about office, and I'll get to that, but I want to touch on retail first. What's your outlook for retail right now?
My outlook on retail is the consumer's in good shape. Not, as I say, not spectacular. Them being in good shape means they're buying stuff. Stuff gets put through retail channels. Let's not talk about auto. That's a separate category. We alluded to that earlier. Sure. But normal stuff, right?
Yeah.
6 out of every $7 goes through brick kind of retail channels. 1/7 goes through online. That 1/7 slowly grows faster than the brick. But as long as the consumer feels pretty good, as long as they have jobs, as long as they have income outstripping inflation by a bit, and as long as there are jobs happening, retail's going to do well. Is all retail going to do well? No, good retail is going to do well. And I learned real estate, I don't know, 40 years ago. My main teacher was Alfred Taubman, but there were several others. And, he was the god of retail. And one of the things I learned was bad retail is bad retail. Not much you can do about it. If people don't want to shop there, they're not going to shop there, no matter how low the rent is.
Right.
Because you can't lower your rent enough to change the price of Rice Krispies, right? And if you can't change the price of Rice Krispies, people aren't going to shop there, right? So you can own a shopping center, you can cut your rent. It may bring a nail salon, but it's not going to bring the quality tenants because it doesn't lower the price of Rice Krispies.
Right.
Good retail is where people want to shop. I mean, it's kind of definitional. And you know it when you see it. It's like the old Supreme Court on pornography. You know it when you see it. Mm-hmm. And there's shades of gray, right? There's no doubt. Yeah. So good retail doing pretty well. Bad retail always is a problem. Because if people don't want to shop there and you're in the business of shopping, tough game. The last thing I'd say about retail is, by definition, it is a hard business. And the reason it's a hard business is you're in the business of satisfying ever-changing retail tastes, right? So whatever is hot today, you almost certainly know is going to be cold 5 to 7 years from now. Yeah. So here you are with a fixed asset trying to satisfy ever-changing tastes. And yes, tastes change in apartments, but not as dramatically, right? They want a bathtub, they want a counter. I mean, yes, the tastes change, but not as radically, right, as the taste of what goes into that space in a shopping center. And so it's a tough business because you're in a business where the tastes are going to change, tenants are going to go out of business, tenants that are strong are going to become weak. And that's the evolution of the business. That's why you want good retail where people want to shop.
Yeah, and I tell you, we've got a number of restaurant clients that are looking for second-gen location, and it's difficult to find. They're great operators. They're looking to expand. They're great operators. So a great operator in retail, it's a key for sure. What's your take on industrial?
Industrial is two phenomena happening. One we just talked about, which is retail. Yep. As long as people buy more stuff is going to have to be stored somewhere, at least for some time period. More boxes to put a face on it. It's not all boxes, right? But more boxes. So the fact that we have more people and we're buying more stuff means more boxes have to be handled and stored somewhere. Now, that's one thing it has going for it. Now, you add to that, as long as the economy is growing, you'll have more imports and exports, right? So more at the ports have to be handled. You'll have more manufacturing stuff, so there'll be more of that type that has to be stored. The second part of warehouse or industrial, whichever you like to call it, is that I mentioned that 1 out of every $7 is being sold these days through online, and that is rising faster than the 6/7 that are going through bricks. That's important for warehouse because items sold through online purchases take about 3 times the amount of warehouse space. And that's because you're dealing with units rather than boxes or pallets. you're dealing with items that have to be handled, a particular shirt, a particular jacket, a particular pair of shoes, as opposed to a pallet of shoes going to the store where they're broken down. Therefore, you have much more activity. If you were in a modern online warehouse, it's very active. A lot of people, a lot of handling, a lot of assembly, a lot of shipping, a lot of small trucks going in and out. If you go to a very good bulk retail house that's designed to deal with brick retailers, it's kind of calm. So the aisles aren't as wide. You don't have all the assembly space. So that 3-to-1, and by the way, it's not a mathematical 3-to-1. It's kind of a ballpark 3-to-1. What it means is that prior to online sales, and this is crude, if the economy grew by 2.5% in real terms, the demand for warehouse industrial space grew by about 2.5%. And that passes a smell test, right? We have more economic activity. We have more need to store boxes, right?
Yeah.
And so, but as online gets bigger and bigger and bigger, a 2.5% growth in the economy, which is more or less an average year, right? That's why I take 2.5%. Needs about 3.3 to 3.4% growth in warehouse space. And that's because to the extent it's increasingly online, it takes more space. And so that feeds it. Now, having said that, industrial has a bit of the same problem in the near term that I mentioned for multifamily, which is a lot of construction got forestalled. The rents went really high. The interest rate was really low. And now we have a supply spurt. The supply spurt is generally not out of control, but it has brought a little softness in the market, but it's still quite good. And as long as people keep buying, that's going to increase the demand. And so pretty good, pretty good.
Yeah. Yeah. It's, I had a guy by the name of Chad Griffiths on. He's a YouTuber and an AI global up in Canada, and he's a big industrial guy. And I was having him on and talk about industrial. We got into AI and industrial, and I asked him, because have you ever seen the Amazon warehouses, the way all the robotics are running them? Absolutely amazing.
One time. It's amazing.
Yeah. And so I asked him, I said, do you think there's any chance that we're just going to go with smaller buildings that are all just AI run? You won't need heating, you won't need air conditioning. Well, depending on where you're at, of course, but
right. Yeah, of course.
And you're going to have smaller buildings, maybe, but they're going to be 2 stories high or 3 stories high, and these robots are going to run everything. Do you think that's something that we need to be looking out for in the future with industrial?
I don't think much in the near term.
Yeah.
If you told me on my deathbed when I'm 100, 27 years from now,
yeah,
maybe, but I don't see it in the near term. I get what people are saying about that, but not massively in the near term. Okay. The one thing that has happened is that the desire to be closer and closer to the consumer pushes warehouses closer and closer to consumers. And the push shove there is consumers don't want the warehouses close to them, right? They go to their governments and say, we don't want them there.
Yeah, not
they want their delivery. They want their delivery, right? But they don't. It's like people who live in the city want all the activity. They just don't want the people, right? That kind of, and I think that's a little bit the same with, I'd like to get real close to the people with my warehouses, but they don't want me because of the trucks and the traffic and the so that's a bit of a tension going on, but that definitely is a phenomenon.
Yeah. All right. Well, now the big headline grabber. Everybody wants to know office. Now I understand there's a lot of office under development right now.
Yeah, the office is a very interesting sector. I'm going to give an oversimplified description of what happened in the office market in the last 4 years. Okay. So I understand it's oversimplified, but it doesn't miss it by much. 4 years ago, that is pre-pandemic, 4 years and a few months ago, right? We had 10% vacancy, right? Just roughly. By the way, some markets had 12, some markets had 14, but let's just call it 10, okay? In the subsequent 4 years, we had 2.5% new supply come online each year. And that's because offices don't get built in a day, right? And they got forestalled during the pandemic, and people didn't know that the demand was going to change. And so when I say 2.5%, is it mathematically 2.5%? No, but it's not way off, right? Not way off. And by the way, 2.5% passes a general smell test, because if the economy is going to grow 2.5%, you'd probably expect the supply to grow around 2.5%, right? So it all passes a smell test. Well, if you were at 10% vacancy and then you got 2.5 more supply, you're at 12.5% vacancy if total demand didn't change, right? And then after a second year, you'd be at 15% vacancy. And after a third year, you'd be at 17.5. And I'm ignoring compounding, right? And you do that for 4 years, you're at a 20% vacancy, right?
Yeah.
And that's kind of where the vacancy is at, is about 10 percentage points higher than it was, which says aggregate demand didn't fall, right? It changed where it wanted to be, the kind of property it wanted, what it wanted in amenities, that changed. But the aggregate demand didn't change. It was the supply that came online. And that's why we've got weakness. The anomaly is, normally if we added, and we have added jobs net over the last 4 years, you would have expected absorption net over the 4 years. And we've had, at best, no net absorption, at best. And we may have had some negative net absorption. So that's how you go to a 22% vacancy rather than a 20, right? And the troubling part is office is a hard sector to start with. It's a really hard sector if you have a lot of vacancy because of TIs and leasing commissions. If you are successful, you're signing your leases in the worst part of a market and locking them in. So it's a bad business that way. And you don't know when demand comes back, because we've gone 4 years where we've had job growth, but we haven't had net absorption. And that's frightening. And until there's greater transparency on that relationship, I'll do apartments, I'll do warehouses, I'll do retail, I'll do hotels, where traditional relationships still prevail between growth and demand. So those other sectors have still more or less prevailing relationships, right? Office doesn't. That makes it very risky. That means lenders don't want to lend because lenders want certainty. And if lenders don't want to lend, that means equity is very hesitant because they've got to come out of pocket with a big bet. And so it's all very muddled. To your point, yes, we do have development because there is, and I think it's a correct belief, if we don't get much growth going forward, it's going to consolidate into the better buildings.
Yeah.
And better is defined by some combination, like retail, is defined by some combination of location and amenities and design and so forth. The best office buildings, which are some combination of design and amenities and location and systems.
Good management.
Yeah, they're going to, and management, absolutely. Yeah. They're going to do best. And I think what's happening on the why is so much being constructed, a large part of why it's being constructed is I think I can build a better mousetrap, and that's the only thing people are going to want to buy. And they're doing okay with the new buildings. It's not like they're doing awful with the new buildings. Mm-hmm. So it's a very odd market in that whenever you have a paradigm seriously challenged for 4 years, it's quite uncertain. And the paradigm that's being challenged is the economy grows, jobs grow, but I still don't see demand grow. That's the paradigm challenge, right?
Yeah.
So I think there's got to be better clarity there before you see a big influx.
Okay. What about bank exposure? Are you seeing, we keep hearing about we have so much exposure to banks. And I saw a property in Texas, actually in Fort Worth, a Burnett Plaza sold a few years ago for 137.5 million, just sold at auction for 12.5. I think the lender took it back. What are your thoughts on our exposure with the banks?
I think the bank's exposure, first of all, is minuscule compared to what we saw with single family heading into the financial crisis. And the reason is because single family debt is, I'm doing off the top of my head, 4 to 5 times as large as all commercial real estate debt, including multifamily. Okay. So the scale of single family was massively larger than the scale of commercial. And then within commercial, office is, and again, I'm doing from memory, something like 18%. Multifamily is the dominant slice, and office is only like 18%. So just do it that way. 10 times, the single family was 10 times larger than the office is, right? And then you go one more step. And the one more step is, leading into the financial crisis, you had vast numbers of single family mortgages with 0 to 2% down, right? If you recall, for 4 years, you had 0 to 2% down, and there was no equity cushion, right? The loss went immediately. First dollar loss went immediately to the lender. And you can say what you will about the loan you just described, the property you just described, but there was real equity that got wiped out before the debt started losing. And therefore, there's greater cushion. Will there be some losses? Yeah, I think there are going to be some losses. It still remains to be seen how big and how extensive. Basically, the only people who are going to sell an office right now are the people who have no other choice, right? No one is going to sell it by choice. And therefore, everything in an odd way is a distressed sale in one form or another. You inherited it, you just want cash, or to be done with it, you don't want to keep it, or it's a foreclosure. Most lenders are trying to kick the can down the road. I mean, I think 300 billion in office was extended last year into this. I think you're going to see something similar, which is, what do I lose by waiting another year to see if the paradigm changes? If I'm going to go from, what'd you say, it was like 130 million to 12 million, how much worse can it go? I'll wait another year. The worst that happens is it's worth 6 million, and maybe it's worth 18 million. And yes, it's still not worth a lot compared to what it was, but if any clarity comes about, it'll be worth more rather than less. So I think you just see a lot of kicking the can down the road, but I don't mean that in a pejorative sense. I just mean it in a strategic sense.
Yeah. I keep hearing people say, oh, there's going to be this huge transfer of wealth over the next few years. Do you believe that to be true?
I don't think it's going to be as big as the transfer of wealth we saw during the financial crisis. Right. I don't think people have still come to appreciate that the financial crisis was the greatest transfer of wealth probably in human history. And it largely went, if you think about it, very simple. What did zero interest rates for 8 years, zero short-term interest rates do for 8 years? They subsidized borrowers and penalized safe savers. Safe savers were mom and pop America, right? Kind of just CDs, checking account kind of savers. And they should have been getting 4%, and they were getting 0 or 0.5%. And that was accomplished by the Fed. It was a huge transfer of wealth from safe savers to borrowers. Nobody ever voted on it in Congress. Nobody ever, can you imagine if it had come into Congress that they said, what we're going to do is let the interest rate be whatever it'll be, and then we're going to tax 100% of it away if it happens to be held in a CD or a checking account. Well, that's what they did by monetary policy. So yes, we're going to see transfers of wealth, but nothing like that scale. Nothing like that scale. That was unprecedented. Right now, you're getting a bit the reverse. You're getting borrowers, short-term borrowers punished, and short-term lenders winning, right? So some of it is truing up a little bit for what happened in the 2010s. But I think the big issue that's happening is back to single-family homes. If you own a home, it's just going to keep going up in value. But it may go down 1 month or 3 months or 5 months. But when you've got a 3.5% shortage, I'm willing to bet that it's going to go up over any sustained period of time, faster than inflation. And therefore, if you're a homeowner in any place people want to live, you're going to continue to do well. And that's a sort of wealth transfer, right?
Yep.
But that's going to continue. And that's largely, by the way, a transfer from people in their late 30s and 40s to people in their 70s and 80s, late 70s and 80s, right? The seller versus the net buyer.
And I know people are going to shoot me if I don't ask you this. What's your outlook for interest rates? You think they're going to raise them, lower them?
I don't think they raise them. They should have lowered them 1.25 years ago.
Yeah.
Inflation is completely illusory. I'm doing off the top of my head. If you people hear about, let's just take CPI. You can do the same thing for PCE. PCE comes out Friday, is always about 100 basis points lower than CPI because it has a lesser weight for housing. But people hear about CPI, less energy and food, right? Because energy and food are volatile. Well, let me give you a different one. CPI, less shelter, less housing.
Yeah.
Okay. Housing is about 37% of CPI. Okay. So you have a little over 72,000 prices in the CPI, goods and services of everything. Okay. And one of them is shelter, actually several of them, but put that aside for a moment. If you do CPI less shelter since August, it's like 1.5% per annum, annualized. Okay. So if you take the 72,000 items, not counting housing, it's like 1.5%. If you include housing, it's 3.4%. What's that tell you? Oh my God, housing. Oh my God, housing. Now the Fed doesn't control housing prices. They don't. They don't. And in fact, it's not even the housing price. They have methodological errors in the data, not they, the Fed, the way the CPI is constructed. One is that the data lags by 6 to 7 months. We don't have time to go into why, but it's well known. The data is 6 to 7 months out of date. You know what's happened to apartment rents in the last 6 to 7 months. They stop going up and they're kind of -2% to +2%, kind of zero over the last few months.
Yep.
That's 12% of the index is rent. And then 25% of the index is a complete fiction that no one has ever paid. So somebody has paid rent, somebody has paid for bubble gum, somebody has paid for sodas, somebody has paid for a lawyer, right? All those are in the CPI. 25% of the CPI is something no one has ever spent a penny on, and it's called owner equivalent rent. And it says, if you rented your home from somebody, how much would your rent be? Well, that's a little like saying, if you had wheels, would you be able to go would you be an automobile? It's a stupid question. As a homeowner, do you own your home? If you own your home, I'm going to ask you a very simple question. Has your rent gone up in the last 4 years? No. You don't have rent.
Right.
They say that in the last 12 months, your rent as a homeowner has gone up 5.8%. Didn't go up a penny. Didn't go up a penny. So 25% of the index, for which no one is paying a dime, is pushing inflation up by 5.8%. And it doesn't exist. It literally doesn't exist. That's why when you take out housing, they call it shelter, we call it housing, you get below 2%. But if you leave this in, it's complete fiction. Now, the CPI is whatever the CPI is. If I can figure it out, anybody can figure it out, right? I'm not that smart, okay? Just go and you look at it and you can do it. If you use a hammer to put a screw in a wall, is it the hammer's fault that it's difficult? No. Whose fault is it? It's the carpenter's for using a hammer rather than a screwdriver, right? The CPI is simply a tool. It's an imperfect tool. It's a decent tool for some reasons and not a great tool for others. The Fed is using it like a hammer trying to put in the screwdriver, ignoring the realities of housing. And when you look at the realities of housing, we don't have inflation. Therefore, holding the interest rate where it's at is absurd. It's just absurd and distortionary, hurts the economy. And the way we said, the 20% of the economy, the rates should be cut. And yet they keep saying, no, we don't think we're going to cut them. And I don't know what they're looking at. My only hope is eventually good sense sets in, right? And people say, well, shame on you for trusting the government to have good sense. Because so far I've been wrong. Yeah. Shame on me for believing they would have good sense.
Yeah. There was some news out this morning where they're talking about raising the rates. And I'm like, are you kidding me? I think it's all headline grabbing stuff. I didn't read.
By the way, one other thing, you asked about the consumer, and I'll pick it up as we're talking about inflation. Sure. People confuse in real life, when I say people, like the people listening, real people, confuse inflation with high prices. The way you get to high prices is through inflation. But just because you have high prices doesn't mean you have inflation still going on. Okay, so let me take that in parts. I'm 6'3". Okay, I'm 6'3". I'm tall. Not NBA, but I'm tall, right? A child who's 4 foot is short, but they're growing. They're inflating. I'm tall, but I'm no longer inflating, okay? So what we had happen versus 4 years ago, 4.5 years ago, let's say, pre-pandemic, are prices a lot higher than they were. Yes, that's because we shut down demand, we shut down supply, demand came back faster. Excess demand drove up prices by about 20% over the 3-year period, roughly. I'm just rounding, okay? So something that was 100 now is 120. So the price is high by the standard of pre-pandemic, by the standard of what we were used to. But it's not inflating very much. It's only going up, unless it's housing, it's only going up by about 1.5%. So it's no longer going up fast, but it is high. And I think what people feel emotionally is, I'm pissed off because prices are high. But that inflation that created it is gone. They're mad about what happened rather than what's happening. Now you say, well, the price of name an item. The newspapers do this all the time. They name an item, eggs. Remember what, 5 months ago it was eggs.
Yeah.
And then 2 months ago it was something else. We have 72,000 plus items out there. You know, half of them are going up faster than average. Half of them are going up slower than average. And some are always going to be going up a lot more than average, at least for a little while, right? There's nothing special there. So that's always the case. And we notice the ones that go up. So here's the phenomenon. Wages have increased a bit faster than inflation over the last 4 years, okay? Yeah. But what people say is, I want the higher wage because I deserve it. I just don't want the higher prices. What I want is the lower prices of 2019 and the higher wage of 2024. Well, the only reason you're getting the higher wage of 2024, not the only, the main reason is because of inflation, right? Sure. And of course, people say, no, 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 I deserve the higher wage, but your wage is a price to somebody else. And so what we have is a situation where I think emotionally people believe they deserve the higher wage. By the way, I always deserve 5 times the wage I get, right? I don't know about you. I deserve at least 5 times what I get, right? So I'm finally getting just desserts on my wages. Mm-hmm. It's these damn prices. Yeah. But if your wage is just one more of those prices, and that's what people have a hard time emotionally coming to grips with, particularly after a period where it jumped like it did, right? They still emotionally have to adjust to that. But by the way, low inflation doesn't mean prices are going to go back down, right? Bread is never going to go back down to 10 cents a loaf like it was in 1971. Right. Not going to do it, right? What happens with inflation spurts is it sets a new ratchet point, right? And you kind of work from there going forward. So if we have 1% inflation, if we have 0 inflation for the next 4 years, remember I said it was 100 and then it went to 120. If we have 0 inflation for the next 4 years, it's still going to be 120. It's not going to go down to 100 with 0 inflation. It's just not going to rise. So that's an important thing to bear in mind. The difference between being tall and growing. And sometimes people are tall and growing, and sometimes they're short and growing, and sometimes they're tall and not growing, all of those combinations. Same way with inflation and prices.
It's a great way to explain that, by the way. Thank you very much. What are your thoughts on a recession? Have we been in one? Do you think we're headed toward one? You don't hear a lot about it anymore. And so I want to get your thoughts on that.
With good reason, you don't hear about it. It was stupid when you heard about it. I was pretty vocal about it being stupid.
How do you feel about it, Peter?
I mean, think about it this way. I started out with this, right? We had a horrific recession. Yeah. We had a horrific recession in 2020, early 21. Horrific. We're not, quote, due, therefore, for a recession until 2026 or 27 by any normal metrics. Okay. And there's nothing that's transpired since then that would change that forecast. We're not due, if you will, right? Okay. Recessions tend to come because of excesses that got built up in the system. And excesses got wiped out in 2020, 2021. Mm-hmm. Weak businesses, overstretched businesses, over-leveraged businesses, they got wiped out in 2020, 2021. So we're still, I didn't see it a year and a half ago when everybody forecasted. I don't see it now. We're still below trend. We've got a long way to go.
Okay. One last question for you. I know we're getting a little long in the tooth here for you, so I apologize. But what are your thoughts? Are we seeing foreign investment coming into the U.S.?
We are what, I'll tell you the fastest way to know that answer. Look at our trade deficit.
Okay.
Look at our trade deficit. If our trade deficit is up, it means our capital surplus is up by the same amount. Why? Because all our trade deficit is we bought more from them than they bought from us of goods and services. That's a trade deficit, right? So as a result, they got a big stack of dollars and we've got a big stack of goods and services. What are they going to do with the dollars? Burn them? Eat them? Use them as wallpaper? What are they going to do with it?
Right.
Well, eventually, they may not do it in one day, but they're going to invest it, right?
Mm-hmm.
And they're going to invest it in treasuries and in real estate and in manufacturing companies and in service companies. So all you have to do is literally look at our trade deficit. So when the trade deficit number comes out, you can see how much foreign investment is here because it basically has to be the same amount with a lag. The timing may not be exact.
Right.
So when people say, oh, this are these crazy politicians saying, oh, the trade deficit is destroying jobs. It's not destroying jobs. It is destroying some jobs, but it's also creating others. What are the jobs it's creating? It's creating all the jobs associated with the investment from foreigners in our economy. Because the way they got the money to invest in our economy was buying less from us than they sold us. And so we have a lot of jobs in financial services, broadly defined, to deal with that money coming back. You can't get rid of it unless what you think is they're doing is burning it or using it as wallpaper, and they're not. So yes, you're going to continue to see it go up. And why do we have a capital surplus, which is the same as a trade deficit? We have a capital surplus because we have thieves in our markets, we have frauds in our capital markets, we have dumb regulations in our capital markets, we have court systems that are not always fair in the capital markets, but you know what? We have less fraud than any place else in the world. We have better regulations than anywhere else in the world. We have fairer capital laws than anywhere else in the world. And we have fewer scam artists than any place else in the world. So if you suddenly got rich and name a country, I don't care, go to Africa, I spend back to where we started in Kenya. And if you suddenly became rich as a Kenyan in Kenya, where would you look to invest? In a market that's safer, more transparent, more liquid, more legit, more predictable. Is it completely legit? No. Is it completely predictable? No, but it's a hell of a lot better. So as long as the world economy keeps growing, the demand to invest in the US is going to grow. Just is.
Yeah, agreed. Well, I think we all can see why you're one of the 100 most powerful people in real estate in New York. Yeah. Well, I do know one thing that I'm very proud to call you a friend of mine. Your charity in Kenya. Can you just give us a brief overview of what you're doing there? Because it's amazing what you guys are doing.
Sure. So it's called SAM, Save a Mind, SAM Elimu. And we started it with 4 children 21 years ago now. After a trip in Kenya, we started with 4 12-year-olds. The notion was we would be whatever they needed resource-wise: clothes, food, school, boarding school, books, whatever it took. Lots of mentoring, how to open a bank account, how to write an essay, how to improve your essay, who was Winston Churchill, everything in between. We have, with the help of a lot of friends and a great staff in Kenya, we have about 170 children in the program currently, in different schools. We don't have a school, but they're in different schools fitting their needs, ranging from like 4th grade, I think, is our youngest, and we have And oh, no, actually, second grade is our youngest. And we have a number of children in graduate school who have been with us for many years. About a third of the children are orphans. About a third of the children are single mothers. And about a third are from two-parent households, but extreme poverty. And it's quite lovely. We've graduated about 350 children over the 23 years at this point. And so it's very heartening because now we've got, we have one child working who will go to work with her MBA at Cortland Properties here in the United States. We have several who are computer tech whizzes in Kenya, and teachers and accountants and cosmetologists and everything in between. And so, but the only thing I would say to people is, if you think you have trouble with your 3 children, we have a lot more trouble because kids are kids. So whatever problem you have, we have like 50 times or 60 times that.
Yeah. It's amazing that you guys are doing all this for those children, and so my hat's off to you for sure. So, Peter, thank you very much for taking the time to come on today. This was an amazing hour of information. Thank you.
Well, thank you for having me, and go to Kenya. It's a great experience.
Well, I'm going to put a link to your foundation down below. I'm also going to put a link to your book as well, because I think, as everybody can hear, the wealth of information you put in that, it's incredible and really gives you a leg up in our industry. So thank you very much. And for those of you watching, thank you for taking the time. If you could, please give us a like. If you haven't done so, make sure you subscribe.